You're listening to Fund Shack. I'm Ross Butler, and today I'm speaking with Jonathan Blake, Head of International Fund Strategy at Herbert Smith Freehills. Jonathan has been called the father of European fund formation, and with good reason. He pretty much invented the private equity limited partnership model and personally persuaded the taxman on the treatment of carried interest. He has since had a stellar career in private equity and venture capital fund formation, advising on hundreds of processes over decades. Jonathan, welcome to Fund Shack.
Thank
we were
you.
talking a few months ago about how the European venture capital and private equity industry got going, because 2023 marks 40 years since the establishment.
Yeah, that's
of the
amazing.
BBC. It is, isn't it? yeah. And, it's a big business now. It's a global business, private equity, but it's been around for less than a working career. And you were in the room really when it really got going, so to speak.
Yes, just about. I don't think I was in the very room where the BVCA was sort of conceived, but I wasn't much later than that. And likewise, the EVCA, now called Invest Europe. I think they were both formed in the same year or within a year of each other.
And so what were you doing at that time? Where were you working, and how did you get roped into it all?
I'd just joined a new startup firm called SJ Berwin. I was a 3-year qualified associate at that point, or 4-year. My then boss, Stanley Berwin, had sort of invited me in, and he had a number of friends who were in the vanguard of the private equity, then called, the whole industry was called venture capital. And it just happened by coincidence that, at the time I was involved in sort of mega mergers, takeovers, investment bankers and all sorts of things. He invited me to dinner one day, and I thought, wow, my boss has invited me to dinner. I was in my late 20s. With my wife. But about an hour before I was due to leave the office to go there, his secretary popped in and said, "You do know you're going to have to talk about the business startup scheme, later to be renamed the business expansion scheme, to a management team and their financial advisors at this dinner." And I'd never heard of the business startup scheme, so I mugged up on it and ended up working for this management team, who were being made redundant from Everready in the lithium battery division of all areas. So I assume that British Everready had decided that it wasn't going to continue with lithium batteries at that time.
40 years too early.
And so I ended up, they agreed to put the redundancy money available to help the team do a startup. And so this was a startup called Venture Technology. I ended up acting for them, and I much preferred that to the big investment banking stuff, mergers, takeovers that I was doing at the time, because it was sort of, for me, in my late 20s, real people who I could help. And so I decided to switch to do only that sort of work.
What were the mechanisms in place for you to help them do what were they trying to do, a management buyout?
Yes. So, I mean, there were standard agreements, corporate acquisition and financing agreements. But because it was a relatively small matter, I could do them all myself. Not that I necessarily knew how to do them, but they didn't know either. So we were sort of feeling our way together.
So what year
and
was
it was great fun. This was in 1982, which was actually the year I joined SJ Berwin. In fact, I think the year of its formation.
In the US, the junk bond scheme was getting going, and there were some massive takeovers going on there, and you would have been aware of that with your big M&A.
I wasn't particularly aware of what was happening in the US, but there were big matters, not necessarily in venture capital as it was all then called, happening at the time. And what I liked about this was that it was smaller, and I could get to know all the people involved and feel I was helping.
So you were working on MBOs, and how did the limited partnership structure then come about?
Well, that was another friend of Stanley Berwin. I just attended, in fact, he left me alone in a meeting with a guy called Gordon Dean, who was setting up a venture capital fund. And he had a list of requirements that he wanted it to meet, which I didn't know at the time because I didn't know anything about venture capital funds, were unusual. The first one of which was it had to be onshore UK. And at that time, to avoid the double charge to capital gains tax, the natural structure would be a company. If investors invest in a company and the company then buys another company, the target business, the only way of getting the money out is through two layers, and you end up with two layers of tax, or at least an additional layer of tax. It was felt right that one shouldn't be subject to that. It shouldn't be any worse than investing in the companies directly. He said he wanted that. He wanted a tax-efficient carried interest, efficient management charges, a whole easy to operate, a whole list of requirements. I didn't have a clue.
Presumably nobody did, because no one had come up with that for the UK before.
That's right, yes. As far as I know, they hadn't been used. As far as I knew at the time, they might not have been used anywhere. Anyway, I was sitting and talking to this guy, and Stanley Berwin popped his head round the door. And I said, well, look, here's your friend, and he wants to do a venture capital fund. And Stanley gave him all the requirements. And Stanley said, why don't you use a limited partnership? And he left the room. And I'd never heard of a limited partnership. I mean, they were sort of a footnote in the textbooks at university, and nobody ever focused on them. I thought it was a stupid idea, but I didn't dare question him. So I instead spent weeks sort of trying to understand what a limited partnership was, configuring it to a venture capital fund, trying to understand how. I didn't know what a carried interest was, but trying to understand the carried interest, and again trying to work out how to make that efficient. It wasn't very difficult because the underlying profits were capital gains, and all I had to do was make sure that the structure in between didn't change the nature of those profits from capital gain to some sort of income. But the limited partnership, being sort of tax transparent, sort of achieved that very naturally.
Can you remember what terms you used in that? Like, so everyone these days knows about the 2 and 20 and
in those days, I think it
hurdle.
might have been 2.5 and 20 for a standard.
Right, but roughly the same kind of model.
Oh, they're very, very similar to what they are now. I mean, this particular fund was £2 million. I think Apax had, which was then called Alan Patrickoff Associates, had just closed a fund for £10 million. So, the whole industry was much, much smaller than what it was now. And 2.5% was thought to be necessary.
Yeah.
And you had to submit a budget to your investors to show that it was justified.
Do you remember who came up with that, or was that part of the limited partnership structure in the textbooks, the fee level and the carry level?
No, not at all. I mean, limited partnerships in the textbooks were sort of used for farming.
Right.
They hadn't been used for investment structures. Indeed, one of the first questions was whether making investments in parallel through a limited partnership, whether that was a business at all, because there were dicta in some cases that said mere co-investment is not enough. And so we had to sort of work out, is this a mere co-investment or is there a business going on here? And we sort of decided the latter, but, who are we to decide? So we submitted, having sort of worked out a structure. I say we, but really it was me. We submitted it to leading counsel, who's experienced in arguing tax cases in the courts, and they could give a sort of idea of what if it ever came to it, they thought the courts might decide. He blessed it, and so armed with an opinion from leading counsel, we used it for the first time.
When did the tax issue come to a head? When did you have to actually engage with policymakers and prove the case?
Well, not long after, the government had got in touch with the BVCA, the Department of Trade and Industry, and the Inland Revenue, both as then called, got in touch with the BVCA, and they sort of said, well, look, we like what you're doing. We're proud of this emerging industry. We're not necessarily keen on your doing it through offshore structures, although, they did make it clear that they understood that the double charge to capital gains tax was not a fair outcome of using an onshore structure. There was a sort of terminology that was used about trying to avoid a technical knockout. In this terminology, avoiding a technical knockout was not tax avoidance. It was something that was fair to do, and the revenue accepted that was fair. By the time we had were invited to discuss this in front of the Treasury, the then financial secretary to the Treasury, Norman Lamont, who then went on to become Chancellor, I went there with the BVCA, and we talked it all through, and we discussed whether it was a business in the first case, and because otherwise it couldn't be a partnership. And they actually had different ideas of how it should be structured, but I think we all agreed that a limited partnership would be better than other structures.
So who's in the room at this time?
Norman Lamont, people from the Inland Revenue, me, and the then chairman of the BVCA, who was John Nash, who
now
Lord Nash.
And that was the point that the limited partnership really became the legitimate format for venture capital investment in the UK.
Yes, but not before me getting sort of grilled as to whether the tax outcome for the carried interest was fair or not. And so, the revenue said, well, look, if captains of British industry are paying tax on their income, income tax on their income, why shouldn't venture capitalists? And I said, because it isn't income, it's capital gain being channeled through a limited partnership. And so we were sort of going to and fro on this question, which, as you know, remains a hot issue until today. At one point I sort of took my courage into my hands and said, look, if you're not going to agree this, I would imagine that people will go on using offshore structures. Why wouldn't they? Because you can achieve a capital gain quite easily using an offshore structure. And so again, Mr. Lamont looked at me and looked at the revenue and said, do you mean, Mr. Blake, if you use an offshore structure, rather, you can achieve capital gains tax treatment for the carried interest? And I said yes, and I sort of had to explain exactly how to do it, which itself felt a bit risky because, it's one thing to have the opinion that something works. It's another thing to declare it publicly and invite everybody to scrutinise it and find reasons why it doesn't work. But, I decided that was a risk worth doing. You have to understand I had, at this point, 6 or 7 clients who I had advised it did work to. So looking back on it, it might have been even a breach of trust for those clients to start telling the Inland Revenue and the government exactly how we'd done it, even though we did believe the outcome was correct. So I explained it, and Lamont turned to the Inland Revenue and said, is what Mr. Blake said correct? And they said, yes. That's all I heard at that point, and he asked me to leave the room and wait outside. Waited outside for, must have been 15 minutes. It was quite a long time to be standing outside a room. And then I was invited back, and the head guy from the Inland Revenue said to me, look, I think we can do business together. So we ended up creating what was called, I think it still exists, the Statement on Guidelines on the Use of Limited Partnerships as Venture Capital Investment Funds. Within that, we set out model terms pretty similar to the terms as they are now, given that these funds were so small, was 2.5 and 20 rather than 2 and 20, but we had to sort of open up our budgets to investors to show why we needed 2.5%, and said 2.5 and 20, 2.5% of commitment for the management fee and 20% of profits for the carry, and quite a few other terms and conditions were set out in that. I'm told now, I didn't know it at the time, Tony Lorenz, Ronald Cohen, some of the titans of the venture capital industry and John Nash were telling me what the standard terms and conditions were, and I put them down. Now, I'm told that until then, they weren't as standard as I was led to believe they were, but that after that, because they were in a document blessed by the Inland Revenue, and some people felt that unless you followed everything precisely, I don't think that was the case, because we were setting out, and we all agreed that we were just setting out what we believed the law was, not trying to change the law, because you need a statute to do that. So we were just setting out what we all agreed the law was.
In the best tradition of kind of common law and declaratory law, just observing what is the standard and then articulating it.
So as I say, I don't think people had to adhere slavishly to the model terms that we did, but people did. Yeah. And so the 2 and 20, or 2.5 and 20 as it started, it got sort of negotiated down fund by fund over many years. But, that became the standard terms and conditions, and they're pretty much the terms and conditions that exist today. It's amazing from a bird's eye view how little has changed.
Well, it is amazing. So that must be the most influential policy meeting in the history of UK European private equity and venture capital, and the amount of value that has been created. I mean, you can't prove a negative, but who knows if you hadn't convinced them and it was treated as profits and income. What the industry would look like today.
I mean, people say all sorts of things about private equity these days, but in those days, there was no doubt that it was, quotes, a good thing. We're investing in, say, that buyout of the battery division of Everready, saving the people from redundancy, helping them set up a business, in that case, tax-advantaged money, then setting up funds to enable other people to do similar things. Was all thought to be a good thing. And, I enjoyed a position for some time where I could just ring up the Inland Revenue and say, because, a particular client would say, well, if we do 2% rather than 2.5%, is it still tax efficient? And I would say yes, but they would be nervous. And so I would ring up the Inland Revenue with them, and the Inland Revenue would say, yes, it still works.
Are you surprised how little change there has been in the essential kind of the top line terms of limited partnership agreements?
Look, the top line terms, yes, I think the answer is yes anyway, but there are lots of second division terms which are still really important. How the key man clauses work exactly. I mean, all these things are, and, those sorts of levels, indeed, even the 2.5%, became 2%, and for much larger funds is less than that. All of that got changed, and that is a lot of money. And what exactly happens with costs and who bears what costs, whether the 2.5% covers everything, or whether the managers are allowed to charge the partnership for other expenses. I mean, all that had to be sort of worked out on a fund by fund basis, and that initially funds varied, but over time those settled down as well. Indeed, there was a time, I remember, when a chairman of the BVCA wanted to standardise all the terms. And he said, "Oh, well, Jonathan Blake will never agree to that because he wants to, charge full fees on every occasion, not work with the stand." But it wasn't me who was objecting. Actually, it was the fund managers immediately told this guy
because they want flexibility.
Because they want flexibility. They didn't think all funds should be the same. Larger fund, a smaller fund. There's a negotiating.
But
position.
there does seem to be some level of market standard which must give either managers or investors comfort. I mean, there must be a reason that there's been so little. If you compare private equity with, say, investment banking or trading or investment bank risk management, how much innovation there's been there in the last 40 years. Tinkering with the second layer of economic terms in an LPA seems relatively conservative, to put it mildly. Although, as you say, I mean, maybe these technical definitions have a disproportionate effect. So what is the 2% management fee based on, invested capital or whatever? I don't know. Presumably that kind of thing can make a big difference.
Yes. Well, the difference between invested capital and committed capital is huge. The standard is committed capital, not invested capital. But obviously, if managers are investing deal by deal, then you can only do it on committed capital because there isn't a fund. And
do you know how things have gone across the Atlantic? So obviously, they use limited partnership funds on similar terms as well. Do you know the evolution story there and how they may have influenced each other?
I don't. I do know that at the time I didn't know that limited partnerships were being used in the United States, and so all of this was being done in ignorance of what was being done on the other side of the Atlantic, which seems extraordinary now. But I thought we were breaking completely new ground, which is why actually the structure and the format of a limited partnership fund agreement in Europe is different to that in America. Indeed, it's why the carried interest in Europe is different to in America. In Europe, it's done on a fund as a whole basis, whereas in America, it's on a deal by deal, albeit with a true up if other deals later do badly. But that true up doesn't often happen. So it's very much thought to be on a deal by deal. You get 20% of the profit on each deal, subject to carried interest, subject to hurdles, etc. Yeah,
and that's a function of the fact that they grew up historically rather separate. You only had telephones and fax machines, not the internet, and so you weren't hugely connected, and so they grew up historically differently.
Yeah.
And that stayed in place, which seems remarkable given financial innovation. It goes across borders, ideas go across borders, but that's proven very sticky.
Yes, it has. You're right. It is remarkable how similar things are at a bird's eye view level.
On the tax treatment question of carried interest, this has been at various points. It's been a very big political issue. Sometimes it dies down, but it never goes away. So you agreed this. Presumably, it was under a Thatcher government. Is that like 82?
Yes, definitely.
Yeah. And it's survived all of the other political colours all the way through.
Well, it's extraordinary, actually. I mean, all this depends on the rate of capital gains tax being different to the rate of income tax. But up to now, who knows what will happen in the future? It's been Labour governments who've reduced the rate of capital gains tax. Blair-Brown government reduced it to 10%, whereas Conservative governments have tended to push it up again.
The industry itself has grown beyond all measure and presumably vastly exceeded your expectations and everyone else's expectations. The fundamental structure, though, has proven incredibly scalable with a few adjustments, say 2% down to 1.5%.
And the limited partnership itself.
Yes.
Yes, not just the terms and conditions, but the limited partnership structure has, because it was untested and it's now become the absolute standard.
Presumably that surprised you as well, the fact that it's so scalable. I mean, because the industry grew pretty quickly during the period between, let's say, 2002 to 2008. You must have been watching it during that period and thinking, well, now we're looking at £1 billion funds. Now we're looking at £10 billion funds. Now, and it still works, and there's no upper limit to that. Apart from maybe the top line economic terms, what are you seeing at the moment in terms of the big changes in the LPA?
Broadly, it's rolling together the economic terms, the personal terms of the holders of carried interest, who are generally referred to as general partners, but they're not. It's normally a company that's general partner, but sometimes the individuals are called the general partner. So it contains their sort of terms of service. So before there were limited partnerships, there would have been a number of different agreements covering the same territory, and I mean, obviously over time that's changed. The whole regulatory framework has changed more than anything. I mean, initially it was largely tax that you were trying to steer your way around to, quotes, avoid a technical knockout. But nowadays, the complexity is very much around the regulatory structures.
Right. So you've advised on hundreds of processes. And the strange thing about, I guess, private equity funds is, as opposed to, let's say, doing deals, is that they are still relatively rare for any individual house, even of a reasonable scale. It's a big event to go out and raise a fund.
Well, it's a life or death event. It's a bet the company event.
Yes, yeah. and they don't do it that often, and so that therefore.
And some people fail.
Right.
That didn't used to happen, but nowadays there are some quite well-known managers who have not succeeded in raising a successor fund, because the fund has a 10-year life. Say, I mean, that's also variable, but the general idea is that it collects commitments, invests in a single set of investments over a 3 to 5 year investment period, and then in the rest of the term of the fund, it develops those companies. And you try to improve the companies. And then sell them, and all that has to happen in a 10-year period, and outcome then is you distribute the proceeds. So it's very much an in and out process. So the fund doesn't continue. When it sells its last investments, it's gone. So each house will raise a series of successor funds. Originally, they all just did buyouts or just did one thing. Nowadays there'll be a house will have different teams doing different funds under the same umbrella.
Yeah. Things are slightly more complicated these days than in the old days, insofar as institutional investors often have their own specific requirements that require a side letter or a side agreement. Are they effectively like mini LPAs on a bilateral basis that connect in with the large one?
They could be, but there is an umbrella term called a most favoured nation status. Investors will insist that they are the most favoured nation. There's nobody getting better terms than them. And if everybody insists that, you end up with a standard set of terms. But you can have layered most favoured nation, i.e., if you're going to invest 100 million into a fund, you might get better terms than somebody investing 1 million into a fund.
They're more equal than the others, then, that kind of thing.
Well, there's and you'd expect that an economy of scale. I mean, often there isn't.
Your day job, you're currently head of international funds at Herbert Smith. What does that actually involve? What's keeping you busy at the moment?
I'm enjoying working within Herbert Smith Freehills to help advance private capital. It now tends to be called private capital because it's not just private equity, but private infrastructure, private real estate, private credit, debt, and indeed the venture capital, the high-risk ventures. Herbert Smith Freehills is a fantastic firm which has real depths of experience in a whole range of different areas: infrastructure, energy, renewable energy, private equity, innovation, tech. All of these really play to strength within Herbert Smith, which is a very large UK law firm. And initially, there weren't that many large UK law firms involved in venture capital. It tended to be the province of smaller. And it's really been over time that it has sort of grown upwards, and Herbert Smith Freehills has grown upwards with it. Part of my job is trying to help as the whole economy sort of has shifted to unquoted companies and investment committees being the where decisions of the future are being taken rather than corporate boards. Working with people at Herbert Smith to move the firm more and more in that direction is part of the challenge. I'm a big believer in private equity, venture capital, private markets. It takes me back all the way to the first investment that I did with that management team from Everready, and the sort of personal nature of it. It doesn't feel quite the same with a multi-million or multi-billion buyout, but essentially it is the same. And so I'm a big believer that it's a better way of doing business than quoted companies. I mean, the share of the cake that the private market represents is still a lot smaller than that of the public and listed markets. And, there are criticisms that particularly the press tend to levy against private markets. But I think it is demonstrable that the performance is often better. So, I think it'll just continue to be onwards and upwards.
Yeah, I hope you're right. I hope you're right. I keep thinking of new questions to ask you, but we've got to bring this to a close eventually. So, Jonathan, thank you so much for sparing your time.
Pleasure.
You've been listening to the Fund Shack podcast. It's the private capital channel for alternative investment professionals. This podcast was designed and produced by Linear B Group, a leading content marketing agency focused on financial and professional services. Thanks for listening.